since 1971, you look at the chart of gold versus the dollar, and it's a gigantic X. That's really all you need to know about fiat money. Now, whether you believe gold is money or not, let's set that aside. It is a physical, real asset that does have use. It's used not just in jewelry, but though that too. It has various uses. It is a physical, real thing that you have to exchange dollars or yuan or pounds or whatever to get. A, fundamentals do matter. Take it, look at the long-term chart. B, the markets are forward-looking. Gold tends to lead inflation. So the fact that we're looking at all-time highs or near all-time highs in gold in 2024 is not a reflection of the 9% inflation we had 2 years ago or 3 or whatever it was. It's actually, I think, the market's signaling higher inflation ahead.
The gold market remains subdued as holiday distractions dominate investor focus, creating a phase of nothingness. Despite this quiet period, signs suggest the market may be attempting to form a bottom while maintaining its broader upward trajectory. Lobo Tiggre, author and publisher of the Independent Speculator, emphasizes the importance of focusing on present market trends and adapting strategies to align with actual data, rather than holding on to ideological beliefs about currency manipulation or precious metals control. This pragmatic approach is crucial in navigating current market conditions. Gold prices have shown signs of recovery from last week's one-month low, marking their third consecutive day of gains. Supported by safe haven flows amid geopolitical risks and trade war fears, the metal maintains a positive bias in early European trading. However, positive risk sentiment in the broader market acts as a headwind, tempering the upward momentum for gold. Additionally, the Federal Reserve's hawkish stance has elevated U.S. Treasury yields, boosting the U.S. dollar and applying further pressure on non-yielding assets like gold. These factors highlight the need for investors to remain cautious, waiting for a clear breakout above resistance levels before anticipating additional gains. Tiggre also notes that while gold enthusiasts often expect continuous price surges, the reality tells a more balanced story. Gold reaching $2,800 and silver surpassing $30 demonstrate substantial growth far removed from past lows and reflect a healthy response to market fundamentals. As the gold market navigates these mixed signals, investors are encouraged to stay grounded in the present, making decisions based on trends rather than speculative narratives. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I would say the fundamentals have mattered. I know that my dear fellow gold bugs are only happy when gold is going up, and silver bugs even more so. It has to be going vertical or something's wrong. It's manipulated, it's controlled. But you know what? It has moved. I mean, come on. Gold, the futures at least, hit 2,800. That is a response to the fundamentals that we've been talking about. And silver over $30, okay, yeah, it should be higher, fine. But it is higher, right? It's not at $15 anymore, let alone $5 or whatever back in the Hunt Brothers days, right? So if you take a step back, take a deep breath, look at the long-term charts. One of my favorite charts is the long-term chart of gold versus the dollar. And that's not a centuries chart. That's since 1971. Because before that, gold and the dollar was defined as a certain amount of gold. So there's really no point in the chart before that. Well, not for this context. So since 1971, you look at the chart of gold versus the dollar, and it's a gigantic X. Right? That's really all you need to know about fiat money. Now, whether you believe gold is money or not, let's set that aside. It is a physical, real asset that does have use. It's used not just in jewelry, but though that too. It has various uses. It is a physical, real thing that you have to exchange dollars or yuan or pounds or whatever to get. And the chart over the time that it has been freed from a dollar peg is a giant, somewhat curved, but a giant X. So yes, the fundamentals do matter. The problem is that they don't seem to matter when we want them to. Right? This just happened. Why, this is inflationary. Why has gold gone down? And so on. So A, fundamentals do matter. Take it, look at the long-term chart. B, the markets are forward-looking. Gold tends to lead inflation. So the fact that we're looking at all-time highs or near all-time highs in gold in 2024 is not a reflection of the 9% inflation we had 2 years ago or 3 or whatever it was. It's actually, I think, the market's signaling higher inflation ahead, which we've been talking about for other reasons. So it's not broken even on that sense. It's out of phase. If you correlate CPI and the gold dollar exchange rate, aka the price of gold, there's almost no correlation at all. But if you shift it, right, gold went up in 2020. but the inflation going up to 9% took 2 years later. Like, so if you shift it, there's a much higher relationship there. You have to look at what's trending now in the market, and you have to be forward looking, as all investors and speculators are. But three, maybe, I don't want to put my middle finger up there, Tom, but three, have some humility. Just you can't believe your own theories so much that you ignore the actual data coming in. I have just admitted in this recording that I was wrong about, my economic forecast, at least part of it, for 2024. And you've got to be able to adjust and, look at what's actually happening and say, okay, silver should be higher. Okay, but it isn't. So how am I going to actually, if my purpose is to buy stocks that are going to go up, or stable ones that'll pay me dividends or whatever, I need to look at that as a financial decision based on the trends that are happening now, not some ideological argument for why, we should get rid of greenbacks and put gold and silver back into circulation. Sure, I'd love to see that. But that's not an investment thesis. That's a political and ideological thesis.
Looking ahead, LoboTiggre anticipates a resurgence in inflation by 2025. While recent data indicates a decline in U.S. inflation rates, with the annual rate at 2.7% as of November 2024, there are signs that inflationary pressures may reemerge. For instance, retail sales have shown unexpected strength, particularly in the automotive sector, suggesting consumers might be accelerating purchases in anticipation of rising prices. Additionally, mortgage rates remain elevated, posing challenges for potential homebuyers and reflecting underlying inflationary trends. The potential re-implementation of tariffs under the Trump administration could further influence inflation dynamics. While tariffs are essentially taxes on imports, their impact on inflation is complex. Importers who bear the direct cost of tariffs may choose to absorb these costs, pass them on to consumers, or negotiate price adjustments with foreign suppliers. For example, Chinese exporters might lower their prices or allow the yuan to depreciate to maintain competitiveness, mitigating the inflationary impact on U.S. consumers. Therefore, the direct correlation between tariffs and domestic inflation is not straightforward and depends on various factors, including international trade policies and currency fluctuations. Let's get back to the interview.
I mean, we came off a fixed gold-dollar exchange rate. Dollar was defined as a certain amount of gold. So I'm not just focusing on gold, but this matters for the gold market, right? You're not coming off. There's no coiled spring there in terms of a peg price. We're going into that gold near all-time highs, actually. So that's very different. But it's also different in that before 1971, you at least theoretically had to have the gold to back the dollar, and now you don't. So we're in a completely different fiscal environment, an economic environment. We are now, decades into the era of pure fiat, which was not the case before, and the constraints are different. So I'm wary of mapping these things on too closely. But is it possible? Sure, of course it's possible. And I've just said that I expect 2025 to see a resurgence in inflation. A lot of people are saying, "Oh, there's no signs of that." Okay, I get it. We have seen on the decline of U.S. inflation as mismeasured by CPI since the 9% high, right? We've seen bumps up and then down. So it is, based on where we're at now, it's too soon to say, no, this is really an upturn, right? It could be one of these bumps on the way down. And I think that's what the powers that be are hoping, that it's like that. But it's simply not true that there's no signs of resurging inflation. That bump could be the bottom and where next big move is up. But even if not, we still have high housing. The mortgage rates are still high. It's interesting how the Fed has cut, and mortgage rates are still something that people are battling with. We just saw a resurgence in auto purchases. This is interesting. The latest retail sales number was interesting. It was higher than I expected, right? Retail sales rebounded. But actually, if you took out autos, retail sales was down. So that's not a sign that everything's great in the economy. But why would people be buying more cars? Well, if they're concerned about inflation, and you've been thinking, okay, I put off buying cars because rates are high or whatever. I've been putting it off, and now, but if inflation's going up again, well, maybe I want to get that car before the interest rate goes up, right? So I think there's plenty of inflationary writing on the wall even before we get to your Trump question. So just put that away. Look at the trends, right? There's plenty of indicators there. Mm-hmm. Now, on top of the Trump thing, I'm actually not in agreement with the idea that tariffs are necessarily inflationary. Yes, the tariff is imposed. The tariff is a tax on imports, so it is paid like literally, like physically, by the importer, which is the American entity. Mm-hmm. And so when Trump says, "Oh, the Chinese will pay for the tariffs," he's wrong in that respect. That it's the Americans who import who pay the tariffs, so it's a tax on Americans. That said, if the Chinese want to maintain market share or anybody else, they could lower their prices to compensate for the tariff. Mm-hmm. Also, Beijing has already indicated allowing the yuan to weaken. So that also compensates for that. So if these compensations ensue, well, okay, you've got the tariff goes up, but the input goes down, the net to the American buyer is the same. So I don't think it's a given that Trump's tariffs are inflationary. What is inflationary, though, is Trump promising to cut taxes on tips and overtime and firefighters. And I don't know if there's anybody. I mean, this is gobsmacking and positive in my view.
The gold market's current dynamics reflect a delicate balance between external pressures and underlying strength. While geopolitical risks and safe haven demand support gold prices, factors like elevated treasury yields and a strong dollar create headwinds. Investors are encouraged to adopt a pragmatic approach, basing decisions on real-time market trends and staying cautious until a definitive breakout occurs. As inflationary pressures and trade policies evolve, their potential impact on both gold and broader economic conditions underscores the importance of a vigilant and informed investment strategy. How will evolving inflation trends and trade policies shape the gold market in the coming years? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.